Supply Chain Finance by Lukmanur Hakim. Supply Chain Finance (SCF) is a financial practice related to managing financial flows in a supply chain. This involves collaboration between suppliers, manufacturers and buyers in order to improve financial efficiency and optimize working capital in the supply chain. Supply chain is the network of entities involved in producing and providing products or services to the end consumers. 2. Finance. Finance is the study of how organizations manage their assets and liabilities, including cash flow, investments, and financing. 3. Supply chain finance. Supply chain finance is a financial approach that focuses on optimizing financial flows within the supply chain to improve efficiency and financial performance. The purpose of SCF is improve liquidity, reduce financial costs, and optimization of working capital. First, improve liquidity. Improve liquidity is one of SCF's main goals because sufficient liquidity is very important in maintaining the smooth running of business operations. SCF enables suppliers to gain fast access to funds tied up in long cash cycles. Usually, suppliers must wait for a credit period specified by their purchasers before accepting payment. With SCF, suppliers can sell bills to financial institutions or use other financial instruments to get cash faster, helping to increase their liquidity. Second, reduce finance cost. Reducing finance costs aims to minimize costs associated with financing, borrowing and other financial activities within SCF. In SCF, suppliers can access financing through financial institutions that work with their buyers. This allows suppliers to gain access to funds at a lower cost than traditional loans, which may have higher interest rates. By reducing borrowing costs, SCF helps increase supplier profitability and reduces the financial burden they must bear. And last, optimization of working capital. Working capital optimization aims to ensure the efficient use of working capital in SCF. SCF can increase the speed of billing and payment processing in the supply chain. By using automation solutions and digital platforms, companies can speed up the bill verification and payment process, reducing the overall billing cycle time. This reduces waiting times and optimizes the use of working capital by ensuring that invoices are processed quickly and payments are made on time. Components of supply chain finance. First, supplier. Supplier is an entity that provides goods or services to manufacturers or distributors in the supply chain. One of the key components of SCF is the ability to offer suppliers early payments. Within the SCF framework, the buying company can pay the supplier earlier than the maturity date specified in the payment terms. This provides direct benefits to suppliers by increasing their liquidity and enabling them to better manage their cash flow. Second, buyer. Buyer is an entity that buys goods or services from suppliers in the supply chain. One of the key components of SCF engaging buyers is the ability to extend payment periods to suppliers. Using SCF, buyers can enter into agreements with suppliers to extend payment terms, giving them flexibility in cash flow management. This assists buyers in maintaining their liquidity and optimizing the use of working capital. Third, financial institutions. Financial institutions such as banks are finance companies that provide financial solutions to facilitate SCF. Financial institutions play a role in providing financing to suppliers within the framework of SCF. They can provide financing based on invoices submitted by suppliers to buying companies. By using this financing, Suppliers can access cash faster and increase their liquidity. Financial institutions analyze credit risk and set appropriate interest rates and financing terms. And the last, financial instruments. Financial instruments used in SCF include factoring, discounting, payment extensions, and international trade financing. Financial instruments play an important role in providing financing, optimizing cash flow, and managing risk within SCF. Selection of the right financial instrument according to the needs and characteristics of the business in the supply chain can help increase efficiency and liquidity for all parties involved. SCF models are divided into four, namely: reserve factoring, approved payables finance, inventory finance, and payables discounting. First, reverse factoring. The buyer helps the supplier obtain financing by confirming invoices accrued by the buyer to the financial institution. Second, approved payables finance. Financial institutions finance bills that have been authorized by the buyer and are due within a certain time. Third, inventory finance. Financial institutions provide financing based on the value of inventory held by manufacturers or distributors in the supply chain. Fourth, payables discounting. Suppliers sell bills to financial institutions at a discount to get cash faster. Benefits of supply chain finance. First, improves liquidity. SCF enables suppliers to gain quick access to funds tied up in long cash cycles. By accelerating payments or using financial instruments such as factoring, suppliers can increase their liquidity, reduce the need for additional borrowing, and reduce financial risk. Second, optimizing working capital. SCF helps companies optimize the use of their working capital. By extending payment periods to suppliers or using solutions such as reverse factoring, companies can extend their cash cycles and improve working capital efficiency. Third, reduce financial costs. SCF can help reduce financial costs in a supply chain. By using financial instruments such as factoring or discounting, companies can obtain funds at a lower cost than traditional loan interest. In addition, by optimizing cash flow and working capital, companies can reduce excessive inventory holding costs. Fourth, improve supplier relations. SCF can strengthen the relationship between a company and its suppliers. By providing faster access to funds, companies can build stronger trust and partnerships with suppliers. It can also help strengthen supply chains, improve product quality, and reduce supply risks. Fifth, reducing credit risk. With SCF in place, credit risk can be shared between companies, suppliers, and financial institutions. Suppliers can reduce credit risk by using confirmation of invoices from buyers, while buyers can reduce supplier risk by providing access to affordable financing. Financial institutions can also help manage credit risk by conducting credit analysis of buyers and suppliers. Sixth, improve operational efficiency. By accelerating financial flows and increasing liquidity, SCF can improve operational efficiency throughout the supply chain. In SCF, payments can be made more quickly, inventory can be circumvented, and transactions can be completed more efficiently. This can reduce cycle time and administrative costs, increase productivity, and reduce waiting times in the supply chain. Thanks for watching.